Hi, it's Mike from Order Flows, and welcome to the Order Flow Trade Setup course. And in this module, I'm going to discuss the first 5 trade setups. But first, a brief disclaimer. Do understand that futures trading contains substantial risk and is not for every investor. So the first setup is flow-generated support and resistance. And, the market gives you a lot of information, right? And you have to take that information because the information that's generated by the market, in my opinion, is the most valuable information a trader can have. So what you're going to do is you're going to look for flow generated support and resistance. And for support, you're going to look for it on the bid side at the bottom areas of green bars, or on the offer side at the top areas of red bars. Ideally you'd like to see it at swing highs or swing lows, but you could also see it in moves as the market is moving up or down. And it tells you what passive traders are doing, right? Because it's the passive bidders that are providing support to the market. It's the passive offers that are offering resistance to the market. And if you're looking at about 25 to 35% of the volume that's trading near the bottom bid side of a bar, it's supportive. If about 25 to 35% of the volume that's trading near the top offer side, that is what you'd consider resistance. So how does it look on the order flow chart? Now I've circled the bars here, all right, just so you can see. Your eyes, honestly, when you start looking at charts, you're going to start noticing this. And really what you're doing is you're looking at the total volume for the bar, and you're looking at how's it trading on the bottom bid side, right? Is it 25, 30, 35% of the bar's volume? Here, because normally it's not. Like here, this bar is 1745, but you're just looking at 172, 130. That's about 300, which is not 25% of 1745. But if you're looking at a bar like this, right, 1294 is the total volume of the bar, and you got 452 there, right? Let's just pull up a calculator really quick. 452 plus 8, what is that? 460, 460, right? Divided by 1294, which is the volume for the bar. It's 35% of the volume that's happening in these two areas, right? At the bottom of the bar and one tick above the bottom of the bar, right? 35% of the volume over the whole bar is happening right here. That tells you it's supportive. Okay, so let's take a look at another example here. This one, 440 and 73. What's that? 440 and 73 is what? 514, right? Divided by what's the total volume for this bar? 1903. 1903. Okay, that's 26%. So you went from 26% here to 35% here. You see how the market's starting to move up. Now here, right, this is a bigger bar, so you could start looking at, one tick higher. On shorter bars, I tend to, bars that are 5 price levels, I tend to look at the bottom 2, but bars that are, 7 or more price levels, this one is 1, 2, 3, 4, 5, 6, 7, 8 price levels. I will also include the third price level. It's basically close to the bottom third of the bar, but I'm really focused on, the bottom 2 or 3, depending on how big the bar is. So what do you have there, right? You got 959, right? 959 plus 188 right here, plus, another 28 contracts there, okay? And then what equals 1175, right? Total volume for the bar is 4314. So we're going to divide that by 4314. It's going to be about 25%, 27%. 27% of that volume is happening right there. And you can see how the market went up. Now let's take a look at another chart. Close this down. Okay, here, right? Again, you don't need to pull up a calculator. A lot of this math you can do in your head, right? One of the clues is that the point of control is on the bottom, so you know that there's a lot of volume down here at the bottom. It's 1545. Right here is already 376. Okay, and I know that's already, you just do the math. Here's another, what is that? 198 plus 376. So that's about 200 plus 374. You do the math. That's 5. That's over. That's over 500. Okay, 574 divided by that, is already over 30%. And you can see how this market went up, came down, came right down to that level. It's providing support in the market. Another chart, okay? 900, 681, 580, and it's 8,000 for the bar. Right now, remember, right? I'm looking at green bars. I'm looking at the bottom bid side, okay? When I get to the sells, I'll be looking at red candles on the offer side, okay? But I know here's 902, 681, 580. Again, I just, you don't need to do the calculator. I know 681 and 580, that's, excuse me, that's about 1,200 plus another 900, is already over, 2,000, right? But again, if you want to use a calculator and do the math, 902 plus 681 plus 580 equals what? 2164 divided by 8685, right? So it gives you 24.9. Now, you say, well, Mike, you said 25% to 35%, and this is 24.9. Well, you round up, it comes out to 25. Even if you want to take it a step further and add in that 726, you could. But, if it's 24.9, yeah, I would still take it as 25. Okay, next one. Okay, again here, right? You don't need, this is borderline because it's a doji candle. I like to see green candles. I included this just because, some people will ask, well, what about doji candles? I like to see green candles for buy, red candles for sell. If you're looking at this doji candle, you can see, well, 5,000, 800, 800. So is that about 1,700 contracts out of the 5079 is right here. Is it supportive? Yeah, technically it is, but I'm showing you this as a doji because I really prefer to see green candles for buys and red candles for sell. But again, would that meet the criteria for a buy? Yeah, it would, but I'm pretty strict on looking for green candles for buys and red candles for sells. And to me, that's a basic thing. I don't understand why people buy on red candles and sell on green candles, right? The market's going up. Why would you be looking to sell it, right? Just as the market's going down, why would you be looking to buy it unless, you see something in the price action, meaning what's happening, in the actual candle itself. All right, so here, right now here's a sell, okay? Again, 4804, all right? You can see it's already 991, all right? So what's that telling you? You're already close to about 25%. You add, so it's basically 1,000. You got 16 and 991. And then you got the 463, right? You could already start doing the math. Now, some people say, Mike, why don't you look at this volume in here on the offers, on the bid side? Well, you can, because really what's happened, as this market is going sideways, people are bidding, and you still got sellers coming in here. But really what I'm looking for are the passive offers here. And you can see how this market sold off, came right back up to this level. Now, there's a few other things in here. Obviously, you got the 2 points of control. So you got 3 points of control along the side, obviously acting as resistance. But I know I've got strong sellers up here, people with supply happy to offer it out, right? Again, you don't need to sit there with the calculator. You can calculate it, but you could almost eyeball it and sort of, you should be able to do the math, hopefully, in your head. Okay, here's another great example, right? Look at this, 5962. Right in here, you got 1,400, 700, right? That's already what, 2,100, right? You add in the 287, right? You're looking at, a very, well over 30%. Market comes off in the next bar, rallies right back up to that level, right? And then it sells off. Again, that's just, it doesn't take. You can use a calculator, but I don't really think you need to on some of these, because you could just use your brain, right, and do the math in your head. I used to do the math in my head. I still do. 2522, right? 5962. Look at that, divided by 5962. Look at this. 42% of the volume in this bar is happening in these 4 price levels. Right? Do you think that's important? Hell yeah. That's very important, right? And you can see it's acting as resistance in this market, and you get a nice quick sell-off. Okay, again here, nice red candle, right? You've seen very strong volumes, 13,400. But you look in here, now this one, you know, it's 3,900 here, okay? It's 2,480 here. Now again, you know, people are going to say, well, this 2,480 is happening right in the middle of the bar. You know, would you include it? Again, you know, if you're going to split hairs and, you know, and have some set of rules that, you know, you can't bend from, you're going to miss trades like this. But again, you know, just take the 89 plus 351 plus 273 plus 3907, right? What is that? 4620, right? Divided by 13440, right? Which is this volume down here, right? That's already at 34%. Now imagine, clear that up, 4620 plus 2480. Okay, what is that? 7,000 divided by 13440. 50% of this bar's volume right here. That's massive, right? If you look at enough bars and do the calculations, you know that anything over 50% on the offer side, you know, above the midpoint is very strong. Okay, so yeah, that's how you can see the flow generated support and resistance, right? Yes, you could use a calculator. Do you really need it? No, not really. You should be able to do that in your head, you know, once you get used to it. All right, so the next setup is tapered buying, tapered selling. And it occurs when the volume traded begins tapering off near the top offer side of a red candle or the bottom bid side of a green candle. Now the key is it has to reach above average volume before tapering off. And I'm going to explain what that means. You know, in the footprint, when I talk about above average volume, I'm talking about the actual volume either on the offer side or the bid side at a price level in the bar, not the total volume for the bar. So what it means is the market ran into strong passive sellers, then immediately turned aggressive sellers, or the market ran into strong passive buyers, and then turned aggressive buyers. So how does it look? All right, so this red candle right here, okay, I circled them for you to make it easy. And really what you're looking for, right? So you see this bar, all right? Volume up here, 399, 524. Okay, is that strong? Yeah, you got a 707 here, 600 here. Yeah, it's above average. But then you see how it just drops off, 524, 2301, right? That's the tapering off. And then the market sells off, just as you have here, right? Okay, 586, right? Okay, is that strong? Yeah, it's actually the strongest point in the bar. Here you got 577, but there's just 586, 45, 1. And so you have the aggressive sellers selling into these bars, into these bids. Then it turns passive buyers, or sorry, selling into the passive buyers, right? The aggressive sellers, right? That's why you have that imbalance there. But then the market turns aggressive buyers, right? You see the buying imbalance in this bar. Just as up here, right? You see strong aggressive buying into these offers here, right? But you have strong passive offers here, right? And then it turns into strong aggressive selling, right? With these imbalances here as the market starts to sell off. Okay, here's another example. Now this one is sort of spread out. You know, I included this one down here, but really the tapering is right in the midpoint of this bar. This bar was quite strong. Yeah, you see the volumes in here, 354, 177. You know, if this bar was cut in half, this would be strong by itself, the 354, you know, the 177, because, you know, 354 is pretty strong for this bar in this point here. But then as you get up here, right, you see the 1197, the 24, the 00, right? And then you see the aggressive buying, right, the imbalance here, the imbalance there. buying imbalance, buying imbalance. So you got the aggressive selling into the strong passive buyers, right? And then the market turns aggressive buyers, right? Just as in here. This one's a little bit weaker, but I just wanted to show you. Sometimes you start to see these things and you see a lot of them, but really what you want to look for is strong bid volume that sort of tapers off. 160, 152, then 24, then 10, right? Then you see the aggressive buying here, right? The imbalance there. Just as in here, right? It goes 191, 105, 26, right? Then the aggressive buying here is 1197, 24, 0. Okay, it's tapering off, right? The aggressive selling that was quite strong here is not as strong as the market starts ticking higher, right? That's why you've got 26, only 105, 191, just as you only got 10, 24, 152. It's tapered off. Okay, here's another one, right? 1050, right? 277, 34, right? It's tapering off. This strong aggressive selling is weakening. Now people will say, well, what about this right here or this down here? Well, I'm looking for it to taper off pretty quickly, right? Here's just it's still strong, right? Here it's 1106, 273. If this went from 1106 to 273 to 20, yeah, I would consider that tapering, right? Now people say, well, what about here, right? You got 34, 100, 337, 524. Yeah, it's not dropping off as quickly as I'd like. I mean, it's borderline, but it really needs to drop off. People say, well, what about this one up here? You got 323, 305. Well, again, this 305 is not heavy volume, above average volume. It's kind of average volume, right? Because here you got 418, then you got a bunch of 200s, high 200s. To me, that's just not above average volume to consider it start tapering off, right? This is definitely above average volume, 1583, right? It's the biggest volume in any of these bars here, except for this one, 1600. And then it goes 500 and then 6, right? It's tapered off. Okay. This one again is a bit border, but again, I still wanted to show you how it can look. 159, 33, 31, right? It's tapered off. Honestly, this one would be much more clearer if it was like 359 instead of 159. But again, sometimes people, they see things like this and they start to get excited. But again, this volume is a little bit light, in my opinion, this 159. Here you go, 566, 381, 97, right? The 566 is nice and strong, right? It's above average. You're looking at 566. Also on the bid side, 693 here. So I know 566 is closer near the higher end of the bar, especially when you look at relative to other bars. 300s, 400s, 200s, 400s. So I know 566 is above average. Then it just tapers off 97 and 64, right? Okay, 1162, 359, 4. It's dropped 20%. 70%. Then it's dropped almost 100%. About 80%. So it went from 1162 to 359 to 4. And really, what's causing this, right? Think about it. What's causing it is this market is selling off. You got some strong offers in here, right? As the market is selling down, right? It's 1100, but it's supply, right? People are thinking, hey, maybe I should start buying it here. They're buying it here, but someone's absorbing all that buying that's going on, right? Because everyone thinks, oh, we're at the low of the day, 55. It's a good place to buy, and they start buying it. But there's someone bigger than them, much bigger than them, thinking, no, this is still a great opportunity for me to get out of my position or for me to get short here at 55 because we're going lower. Boom, boom, boom. Now, people say, well, what about this one in here? 754, 521, 212. It's not really dropping off very much, right? 754 to 521 is, 200 contracts. And then 521 to 212, it's about 300 contracts, right? You really want to see a drop off through 1100 to 300, then from 300 to 4, right? It's really tapered. Okay, that's really what you're looking for. but you're looking for the heavy volume, the not so heavy volume, and the tiny volume, basically. Now sweeps. I've talked about sweeps, and actually on my software I do have a function for sweeps. Okay. Now what is a market sweep is, well, it occurs when a large trader wants to get into or out of a position ASAP, right, as soon as possible, and he's going to trade through several price levels at once. Now again, have context where a sweep occurs. Oftentimes you're going to think you see a sweep that's happening at the edge of a bar, right, the bottom of a candle or the top of a candle, and you got to be careful with those. Really what you want to look for is sweeps in the inside of a bar, the area between the high and the low, preferably in the body of the bar, so to speak, not the edge of the bar, the top or the bottom, right? And generally you're going to look for ending balance should be bigger on the volume than volume on the bid and the offer. Not always, but basically imagine the market is 5 bid at 6. Someone says, okay, buy me 1,000 up to 8, right? They sweep the market, the 6s, the 7s, and the 8s. They turn it 8 bid, and they will often have some residual volume left over on that 8 bid. I'm going to show you that in a second so you can understand what I'm talking about, right? So there's going to be a solid bid there, all right? Or if they're selling it, there'd be a solid offer. And oftentimes, but not always, you're going to see when there's a sweep, it often leaves a trail of a stacked imbalance. But this is really where it gets interesting, is because it doesn't always leave a stacked imbalance. And when it doesn't, if there's a sweep there, you can profit from it, right? Because again, you're going to see what other traders can't see. Okay, so here's the sweep right in here. Boom, boom, boom. Again, I'm not looking necessarily, I don't put a lot of weight in sweeps at the bottoms of the bar or at the very top of the bar, right? I'm looking for it sort of in the body of the bar. And oftentimes in a sweep, what you see is very little counter trade, right? You can see, the sweep probably started right here, right when it was 27, 20, 26 and 3/4, 27 offer. And again, they bought it up to, about, they're probably trying to buy it up to 8, but they just bought it up 3 price levels. So you can see when they left that imbalance here with very little counter trade. Now it doesn't mean that there's not going to be counter trade. Right? What do I mean by counter trade is when you're buying it, someone else comes in and sells it at the same time. And in these markets, there's always a lot of trading going on. So you always have these in-flight things where you're the big trader is buying 500, but at the same time you got some other traders coming in and selling. As one order is executing, the other one's also executing. So you can see all of a sudden there's decent bid here, right? The 148 against the 214. So they bought the 285, the 49, the 214, and they turned it bid here. Okay, and it probably looks like they just upped their bid a bit. Now you can see them sometimes, again, when you're looking at the bottom of a bar like this green candle here, you got to realize that's, especially on a minute-based chart, right? Understand how your bar forms. Okay, so if I'm looking at this at the bottom of the bar, oftentimes you see a little squirt up at the beginning of a bar or the end of the bar, because this is a time-based chart, right? And it's just based on time. So I'm not necessarily putting a lot of faith right now into this one. The one thing that does intrigue me about it is this 136 here. So I see somebody's buying, the 57s, the 36, the 76, and they turn it bid here. Okay, I like that, right? But oftentimes you just sort of see thin volume at the bottom of the bar. So let's just go through these other ones here, right? Just really quick, I talked about tapering here, 404, 146, 62, 2. It's a nice taper right here. But anyway, this again is happening right at the beginning of the bar. But what I like is the thin volume, very little counter trade, and then the heavy volume down here, the 151, the 256, right? Then it comes right back up here, very thin volume. Would I consider this a sweep? I don't know. I like sweeps when you're sort of breaking to new levels, not just sort of going sideways like this, right? Just as this one, would I consider this a sweep? I put this in there. I don't really consider this a sweep, but I want you to recognize something, right? This one and this one, right? And this one. this is happening in an area that we're just trading in, right? Is a big trader going to sweep through an area that we're trading in? Generally not, right? They're generally looking for, again, areas where, how to say it, areas of influence, all right? Areas that, we can break out because, the market is slowly ticking down. Okay, now I can whack it, right? Not just after it just sold off. Okay, yeah, I'll go buy it back. I mean, they can, but really what you're looking for is, ideally is somewhere where you're sort of breaking out, and then they come in, offer it down, hit all the bids, turn it offer for some decent volume. Now here, they bought it up, turned it bid. Okay, here I would not consider this a sweep because I'm not really seeing that bid volume coming in here, right in here. This just sort of looks like normal trade. But again, I put that in there just so you can get your head around what normal trade looks like, as opposed to me, this is more of a clear sweep. And this one is also, to me, is a borderline clear sweep, but I just don't like where it occurs in the bar. Okay, here, right? We're trading. We just rally it back up to unchanged. Sellers like to buy or sell unchanged depending on where we are on the day. You come in, sell it back down. Boom, it happens really fast, right? They hit this bid, hit this bid, hit this bid. There's some counter trade. Then you can see it turns it offered right here, the 182, the 279. Come down to the new lows, start rallying up. Boom, a nice, this to me is a beautiful sweep here, right? You see 000, 112, 592, right? This bid volume is bigger than this offer volume, right? That's really what I love to see. To me, those are the best ones to see, right? Because basically someone's, they buy it from 52 all the way up to 53 and a quarter. They turn it bid right here, right? And then you see even there's a bigger bid right above as the market starts going higher. That's because when a trader sweeps the market, right, they put the whole, generally they'll put the whole order in because they don't know if there's volume that's being iceberged in here on the offer side, right? So, I got 1,000 to buy. Okay, where's the market now? 52. Okay, put 1,000 in to buy. Show 100. Buy it up to 2, or buy it up to 53 and a quarter, and then they turn it bid there, right? So whatever they don't get executed on here in the volume, then they're just happy to buy, work that bid here now. Because big traders, really what they look at is they look at their average price. They're not concerned with, I only bought 220 here and I bought 159 here. Okay, so I bought my 1,000. What's my average? My average is 52.456. Okay, where's the market now? 53 and a quarter. Good job, right? That's that's how the big traders operate. Okay, now again, this was that tapering part right here, right? So remember what I showed you this just now, right? You have some tapering, then you got a little bit of a sweep here because what's happened is sellers were selling into this big strong bid here, right? People, they didn't know how strong this bid was till they realized, oh my God, probably once it broke 1,000, people realized, hey, you know what, this bid is quite big. And then someone got aggressive and basically just lifted these offers and turned it bid here, right? And the market continued higher. This area up in here, is kind of one of these types of sweeps where someone just doesn't necessarily go in and whack it down in one big order, right? It just sort of came in here and there was some selling, right? To me, this is sort of a combination of a sweep, combination of algorithmic trading, because someone is definitely selling it here. They're getting aggressive, right? But there's just not a lot of volume, right? And there's trade going back and forth, but then they turn it offer right here, right? The 411, right? And it just never comes back to that area again. So they're just sort of, trying to finesse it, sell what's there, sell what's there. Then it starts getting away from them, and then they just whack it right here. And that's why you got that 411 there. But again, oftentimes when traders realize they're wrong, they're selling into an abyss here, this 1197 on this bid. They realize, there's buyers here supporting this market. that's when they turn and just lift the offers, just get me out, take my loss and take my ball home and come back another day. Okay, here's a nice one, right as we're sort of breaking out below this level here, boom. I would not consider this tapering here, but you see the 466, right? But right below that 60, 116, 112, 367, it just dropped, boom, you got the imbalances there. Someone just swept through these two prices, and work it lower, boom. That's a sweep. That's a clear sweep. It's happening in the body of the bar as you're sort of breaking out of a level. Similar, right? Your swing low is here. You got a sweep coming in here, about to break out. Someone just says, oh shit, we're coming into the swing low. Sell it, right? They sell it. Boom, 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 boom. Turn it offer right here, right? 0, 2, 111, 174. They're just clearing out these bids. There's not much bids there for them to clear out. They just clear them out. 30, 37. That's what 67 plus 245 is about 300. Another 100 here. About 500 is all it took for this sweep to happen. Now, when there's a big data release or someone from the Fed opens their mouth, obviously this is a sweep, right? You should be familiar with that type of sweep action. Boom, Powell says something, market just immediately drops 2 handles. Boom, that's a sweep, right? These algos just come in and swept everything. Now who does sweeps? The big institutional traders, the algos. Right, these things that are programmed to interpret tweets and data also sort of have free reign to sweep through the market. That's why you see, things, when there's a interesting tweet. You don't get it as much as you used to when Trump was in office, but if you ever, you go back through time and you look at, influential tweets. When the Boston Marathon bombing, you had a big sell-off, right? And it was just someone, these algos, execution algos that read the tweets, just hit every single bid for how many handles, right? It's not a flash crash, it's a sweep coming through the market, because obviously somebody, I think that day was, what was that, the 22nd? I think Powell said something. Okay, here you're sort of breaking out to new lows, right? You hit down, you posted, came down here, right? Candlestick guys, oh, this is the hammer, you got to buy this hammer. Okay, then it starts working down here, but the big traders say, what, let's trap these guys. All these guys that are buying this hammer, we're coming down here, boom, they just sweep the market, 0, 0, 537. This is a classic sweep, sweep, sweep. Leave your offer there. 1,000 contracts to sell as you're breaking out. 134, 138, 178, 537. Right? They just hit this, hit this, hit this, and work the offer. That's a classic sweep example. Let me drink something. Okay, so the next one, number 4, is wicked reversals. And it's when opposing imbalances appear in the wick and directional imbalances appear in the body. Now, I've talked about something similar to this. It's called second slot imbalances or imbalance reversals. But really what this is you have like a green bar, but you got a selling imbalance towards the bottom of the bar in the wick of the candle, and then you have buying imbalances in the body, okay? Or a red candle with buying imbalances in the upper wick and selling imbalance in the body or lower wick. So how does it look here, right? Obviously this is your candle, the body, this is the wick, okay? Now point of control does not need to be in the wick. You're looking for the imbalances in the wick, so you're looking for the aggressive selling out of the body in this case, and then the aggressive buying in the body or above the body. So you got aggressive selling as you're pushing down, but then aggressive buying as you come back into the body and you start rallying, right? Here's your imbalance, your selling imbalance, then your buying imbalance, okay? Now for a sell, it's going to be the opposite, but I'll get to those in a minute. So here's your candle in the wick, selling imbalance. The buying imbalance is on the way back up as So you imagine how this bar is forming, right? You open up, you start trading lower, and then you got the selling imbalance. But then things change for whatever reason. Turns a green candle. You start trading into the body. You got the buying imbalances in the body, right? Then you look for the market to go higher. It's very visual. All you got to see is, okay, where's the candle? Where's the wick? Do I got imbalance? Selling imbalance? Yes. Do I got buying imbalances in the body? Yes. Here's one. But you don't have the buying imbalances in the body. You have the selling imbalance in the wick, but you don't have the buying imbalance, right? Now this is not an example. Here you have a selling imbalance, but it's in the upper wick. It has to be in the lower wick for a green candle, right? Just as a red candle, you're going to need this buying imbalance in the upper wick and the selling imbalance in the body or the lower wick. This is opposite. This one is opposite. This one you don't have the imbalances in there, right? Because you're not going to just see the imbalance by itself, right? The selling imbalance and immediately get long. I mean, you can, but you know, that's not how the setup works, right? Just as these two candles, right? 206 versus 12, yeah, you have a selling imbalance in here, but it's in the wrong area, right? You need it to happen here, not up here, because oftentimes this is where you're often going to see a selling imbalance. This is often where you're going to see a buying imbalance, right? But when you're seeing the opposite happen, that's when you're going to act. Okay, here, selling imbalance in the lower wick, buying imbalance in the upper wick, or the body. In this case, it's in the upper wick. Okay, not this, right? It's a selling imbalance, but it's in the upper wick. The selling imbalance has to be in the lower wick, right? And the buying imbalance obviously has to be above the selling imbalance. Right here, you have your selling imbalance in the lower wick, the buying imbalances in your upper wick, right? You got a nice little move here. Here, this one, again, it's not in the wick, but, you know, it's towards the bottom. You know, you could, you know, do you want to split hairs? You know, I just find it better to be in the wick than here, right? I do like when I got the imbalances in the bottom, but, you know, there's some nice volume in here. You got a lot of nice things going here. You know, but then obviously the market sold off on some on Yellen speaking that day. Now this is how it looks on the sell side, right? You have your buying imbalance in the upper wick. You have your selling imbalance in the body, right? Or in the lower wick would be acceptable, right? That's where you want to see the buying imbalance, in the upper wick of a red candle. Right, just like here, right? You got the selling imbalance, the buying imbalance in the upper wick, selling imbalance in the body. And think about the mentality of what's happening, right? We opened up here, right? Then we traded up, and then you ran into supply. People were trying to buy here, right? You had this nice green candle, and people are buying, but it ran into supply. That's why you have this buying imbalance, right? And oftentimes you end up with positive delta on red candles like this. It's because someone is supplying it out. Once these buyers realized that they're basically wrong, right, this market's not going higher anymore, they became sellers and became aggressive sellers and got out of their positions, right? And what did the market do? Well, it sold off. Another two examples, right? In the upper wick, right? But this one doesn't have the imbalances here. Again, ideally, I like to have the selling imbalance in the body like you have here. Okay, so it's upper wick, buying imbalance, body, selling imbalance, upper wick, buying imbalance, body, selling imbalance, but there's no selling imbalance in here. Notice this one struggled, whereas this one, the move happened immediately, right? That's what you want to look for, right? You want to take the trades that are going to happen soon rather than later. Right? You don't want to sit here and wait around for how many bars before it finally breaks, and having those imbalances in the body gives it that extra momentum. Okay, last one here, right? Upper wick, imbalance, buying imbalance. Now, I'm not looking at upper wick for a selling imbalance, right? I'm looking for upper wick on a red candle, a buying imbalance, just as I'd be looking for on a green candle a selling imbalance in the lower wick, right? But I don't have one on this chart. And then on the way down, right, what you have is aggressive buyers coming up here near the high, realizing they're wrong, and then turn aggressive sellers. Boom, right? Traders who are trapped, basically, selling out. Boom, boom, boom. Aggressive, right? Market, next bar, lower, 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 lower. All right, so the last trade setup for this module is one of my favorite trade setups. It's called the lightsaber trade. And, you know, if you're a Star Wars fan, right, you understand what a lightsaber is, okay? There's no explanation needed. And basically what you're looking for is a long green candle with a low POC, and for the bar to open at that POC, right? Or for a sell, you're looking for a long red candle with a high POC and an open at the POC. Now this differs from the heavy wick in that the POC doesn't need to be lower than or higher than the swing high or swing low. And I'll talk about the heavy wick setup. I think it's in the next module. So what does it look like? Well, it's very simple. It looks like a lightsaber, right? Your green lightsaber, right? This is your handle here, right? This is your lightsaber. This is the protector there, right? So you're grabbing the lightsaber here. Boom. Nice dramatic move up. Boom, up, 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 up. Now you're looking for the point of control to be either, in this case, it opened right on the point of control, or it could open, one tick up below the point of control, which I'll show you on the next chart, I think. Okay, here it opened one tick below. Notice the difference, right? It opened right on the high here, okay, of the point of control. So it opened right on the edge, whereas the previous one, right, it opened right here at the bottom of the point of control. So either one, all right, either one, as long as it opens on the point of control. This is your handle. That's your little protector. That's your lightsaber, right? Green is good, right? Green means up. You're looking to trade it up. Again, opens right on the level, right here. All right, this is your point of control. There's your lightsaber. The thing that I like about this is oftentimes you see imbalances in the direction the market is going, right? And it tends to be a nice elongated bar that's telling me there's volatility in the market, right? Because what is volatility? It's the market searching for price levels to transact at. So it tends to be elongated. So you tend to notice momentum picks up right after that lightsaber comes in, right? Here's a bearish one right here, right? Here's your handle. Opens up right on, in this case, the bottom, right? And then you're seeing the selling imbalances, right? So you see momentum is picked up and you get a nice little move down. Again, I like trades that move quickly, right? There's no point in looking for trade setups where the trades, is going to take time to develop. A good trade setup, the market moves to your take profit quickly, right? Trades that sort of hang around and do nothing, aren't very good trades in general, right? You want momentum, you want price action, you want order flow, right? You want everything happening at the same time. Here's your handle, right? Here's your protector, here's your lightsaber, right? Red is bearish, right here. Right now, I'm not going to be looking for a green lightsaber to sell, right? I'm looking for a red to sell, green to buy. Okay, this is your handle, right? Boom, goes lower. This is not considered a lightsaber because you're not going to grab the saber itself, right? You're going to grab the handle. There's no handle here for you to grab. Okay, now this one, again, I wanted to show you because I'm looking for a long one. I'm not looking for a pocket knife, right? Even though the point of control opened at, place I like, the fact that it went up and came back down is not good, right? You're looking for a long saber, right? You're not looking for a little Bowie knife or something, If it might be different if this bar closed here, but you got all that, I'm not looking for a sword with another sword on the end of it, right? That's not useful. You want this, right? You want this, right? The long sword of the bar, right? You want that, right? Where it closes up near the top of the bar, right? You don't want it where it just sort of hangs around, piddles out like this, where it goes up, it looks like it's great, it looks like it's happening. You know what? Not now. And it just sort of comes back, and then you can see what happens. inside, inside, inside. Right? You just went inside this bar over the next 3 bars before failing. Right? So even if you took this trade, the fact that it can't go any higher over the next 2 bars is definitely not a good sign that this one would work out. But again, it's not long enough here to be a legitimate trade. So that concludes this module on setups 1 through 5. So let's move on to the next modules, module with the setups of 6 through 10. So I'll see you there. Bye-bye.